Still ahead. Here's Mike.
All right, thank you, Janice. It's time to talk about your money. We're going to be talking about the markets in the news lately in your 401k. But first, we're going to talk about a kiddie tax. What is that? Stewart Welch from the Welch Group joins us to talk a little bit more about it. This is one of those gotcha taxes that could happen to you in terms of your college funding. So first of all, explain to people who don't know, what is a kiddie tax and how do you prevent yourself from getting hit with it?
So Mike, kiddie tax, people are, one great strategy is to shift income to low income tax bracket folks. That would be children as an example. So you shift, you give them, for example, a stock that you have a really high gain in, let them sell it in their lower bracket. But the problem is this thing called the kiddie tax. Okay. So it's a tax that says any income, it'd be interest, dividends, or capital gains above $2,100 gets taxed back at your highest rate.
Oh, okay.
So, and it applies to children that are under the age of 19 if they're not in college, and if they're in college under the age of 24. So the first thing is there's still a planning opportunity. So you could still shift, you could give them a mutual fund or you could give them a stock with a capital gain in it. As long as that gain's under that $2,100, they're not going to pay any tax on it, whereas if you sold it yourself, you would pay the tax at your highest capital gains rate. Or again, if they're over age 24, you can do large amounts because then you're not subject to the kiddie tax, and you can have gains up to about $37,000. So it's a big opportunity there, but you want to be careful you don't get snared in that kiddie tax.
Okay, well, good protection tips right there. All right, the other thing we're watching, of course, everybody's 401k, they were feeling pretty good about it for a while, really for the last month or so. And then we have some instability, some uncertainty caused by some of the actions we believe, and it could be related to the actions that's coming out of the White House. So the Dow was down yesterday, back under 20,000. Should people be concerned? What should they be doing with their money?
Well, I think the first thing is that it's been a wild ride, right? On election night, market was down 900 points,
right.
Fully recovered by the time the market opened that morning. From there, it moved on up and crossed 20,000. The Dow did, a big number. And this is what I call the Trump effect. So when you saw the market fall off yesterday, a lot of that was due to the ban. So there's marches everywhere and a lot of protests going on. I'd say that, and understand that the stock market is nothing more than a reflection of investors' outlook. Okay. So when you had this massive protest, they became more skeptical. But here's what I would say. When you look at everything that Trump's doing, it is all positive, should be positive for the economy, for corporations and the markets. So he's talking about cutting taxes, that's going to put more money in people's pockets. Right. He's talking about less regulations. He talked yesterday about for every regulation that we have, we're going to cut 2. And that's great.
So some of the policies are, but this, and we do have to wrap, but obviously some of the big CEOs or some of the big companies, Microsoft, Apple, they came out against this ban because of what it's hurting their business, and that could have a negative effect too. So it's
I think that's very short term. So if you look out for 2017, 2018, I think it's very positive. I would be an investor in the market.
All right, Stewart, thank you. Appreciate it.
Mike.
All right, 741.